Hello guys, today I will talk about inventories and the effects of inventory costing methods on income determination and on income taxes. Okay, effects of inventory costing methods on income determination. The disclosure of inventory methods. The full disclosure convention requires that companies disclose their inventory methods, including the use LCM. Means that least common multiple on the math functions. And in this function cost flows four types of the disclosure convention. First of them, specified identification method. Second one, average cost method. Third, FIFO, means first in first out method. And the last one is LIFO, is the last in first out method. And the specified identification method, it identifies the cost of each item in ending inventory. As you see in the table, and as you see on the table, the specified identification method may appear logical, and it can be used by companies that deal in high-priced articles, such as works of art, precious gems, or rare antiques. However, most companies do not use it for the following reasons. The second one, average cost method. Under this method, inventory is priced at the average cost of the goods available for sale during the accounting period. And on this table, the average cost method tends to level out the effects of cost increases and decreases because the cost of ending inventory is influenced by all the prices paid during the year and by the cost of beginning inventory. Some analysis, however, criticizes this method because they believe recent costs are more relevant for income measurement and decision making. The third method, FIFO method, and this method assumes that the cost of the first items acquired should be assigned to the first item sold. And on the table, this FIFO method values ending inventory at the most recent costs and includes yearly costs in cost of goods sold. And during the periods of rising prices, FIFO yields the highest possible amount of net income, because cost of goods sold shows the yearly costs incurred, which are lower during periods of inflation. Fourth method, LIFO method. The LIFO method of costing inventories assumes that the costs of the last items purchased should be assigned to the first item sold, and that the cost of ending inventory. And this method have table. On this table, you can say that the cost of ending inventory should reflect the cost of the goods purchased earliest. Under LIFO, the April 30 inventory would be $5,100. And the effect of LIFO is to value inventory at the earliest prices and to include the cost of the most recently purchased goods in the cost of goods sold. As you see, we have effects of inventory costing methods on income taxes. Effects of income taxes. The Internal Revenue Service governs how inventories must be valued. for federal income tax purposes. IRS regulations give companies a wide choice of inventory costing methods, including specific identification, average cost, FIFO, and LIFO, and except when the LIFO method uses it, it allows the M to apply the lower of cost of the market rule. Okay, about the table. On table, we can say the LIFO method is used. It always apply to lower of cost of market rule. However, if a company wants to change the valuation method it uses for income tax purpose, it must have advance approval from the IRS. And this requirement conforms to the Consistory Convention. A company should change its inventory method only if there is a good reason to do so. The company must show the nature and effect of the change in the financial statements. And many accountants believe that using the FIFO and average cost methods in periods of rising prices causes businesses to report more than their actual profit. And when a company uses the LIFO method to report income for tax purposes, the IRS requires that it use the same method in these accounting records. And as we have noted, it disallows use of some LCM rule. The company may, however, use the LCM rule for financial reporting purposes. Okay, guys. Thank you for the lesson. That's all. Bye-bye.